How do early RIA co-founders develop an industry reputation for being innovative consumer marketers long before consumer lead gen was a thing?
We often said we're a marketing business that happens to be in financial services. And we would joke like that just to remind ourselves how important it is, because the lifeblood of any advisory firm is new clients.
And how does that original founder-led business evolve into one of the nation's fastest growing RIAs?
If we don't have happy advisors, if we don't have an efficient service team, then that's going to lead to a really poor client experience. So as long as we're elevating everybody's experience, we de facto are elevating the client experience.
On this episode of Growth Leaders of Wealth Management, I'm talking to Allworth co-founder Scott Hanson, CEO John Bunch, Director of Client Experience Victoria Bogner, and investor from Parthenon Capital, Andrew Dodson. To turn successes from the past.
In the mid-90s, they started a radio show in Sacramento, which they built on for 20 plus years. And as they got name recognition in the space, they developed a level of sophistication around that direct consumer marketing, which again is pretty unique.
Into learnings for the future.
AI is a bit like Y2K. I think everyone thinks, well, really, how important is AI going to be? I think that it hasn't hit this industry yet, but I think that it's going to be the biggest transformational change that we've seen in the last 30 years.
Join me as we follow Allworth's journey from local legends to one of CityWire's top 50 growers across America, right now on Growth Leaders of Wealth Management. Scott Hanson and Pat McLean are probably best known in their home base of Sacramento for their radio show Money Matters that's been running for almost 30 years. In founding Allworth, formerly known as Hanson McLean, they knew they wanted to be a different kind of RIA and develop new client relationships in a way that broke from traditional wisdom. From the beginning, Allworth has stood out because they are an RIA that operates with marketing as the top priority instead of an afterthought. Here's Scott on the early days of Allworth.
We often said we're a marketing business that happens to be in financial services. And we would joke like that just to remind ourselves how important it is, because the lifeblood of any advisory firm is new clients, right? And matter of fact, you look at most firms aren't growing at all. They're not bringing on new clients. The only firms that are growing right now are the very large ones that have some sort of marketing engine behind them and a client acquisition strategy. And so, I didn't want to be one of those advisors that my business card was a sponge, and like every time I met somebody, I tried to convert them to a client. I remember when I graduated out of college, first firm I worked with told me that everyone's a prospect, Scott. Everyone's a prospect until you talk to them, then maybe they're a suspect. And so I just remember thinking, I don't want to live my life like trying to everyone I meet to turn into a client. There's got to be another way about doing this. And so we first started just working with retirees from the phone company. And back in the original day, we'd have workshops and put flyers and have flyers distributed throughout the buildings and stuff like that. Just use really old school methods. And then we've done a radio program for almost 30 years. We have more podcast listeners now than terrestrial radio. And then we've done a variety of other things. And marketing, it continues to this day. It's still a lifeblood of our business. We've got 20 some odd, maybe close to 30 people on our marketing team. It's a huge budget item for us. It's really important that we generate new clients.
In 1993, Scott and Pat were some of the early pioneers of the RIA movement. Their dedicated focus on direct consumer marketing set them apart even more. The focused target market, consistent radio show, direct mail, seminars, and workshops built a highly differentiated RIA firm. I asked Scott why more firms didn't follow suit in the early days.
It's hard. I mean, because marketing, at some point, you're reaching out to somebody who doesn't know who you are. Most firms don't have a national brand, right? If you're Merrill Lynch or something, that's one thing. Most people we don't. Like nobody knows who Allworth is really, and so you've got to reach out to some potential consumer that doesn't know who you are. Have a story that's interesting enough to get their attention, long enough to pay attention to what you might have to say. Hopefully, you have a message that resonates with them at the time that they're needing of something, and they'll raise their hand and say, I'd like to have some sort of conversation with you. That's very hard. It's very challenging. And it's the payoff it takes time. It takes a long time. When someone invests in marketing and they expect that they're going to get a bunch of clients, the next week or something, it doesn't work that way. Particularly if it's any sort of brand marketing, it might be years before you get a payoff from that. So I think the challenge is it's a little more complicated. Well, it's clearly more complicated today than it was 10, 20 years ago. Yeah, but it's fairly complicated, and I don't think most advisors have the patience to see through a full marketing campaign. That's the reality. They try something, doesn't work, and they give up on it.
As a business, when you find a strategy that works, it seems intuitive to try and replicate that approach as you grow into new markets. But Scott and Pat soon discovered that unprecedented growth will always present new challenges. It is unsettling to break from what you know, but Allworth as a business is unusually unafraid to pivot. Let's hear from Scott on some of the marketing struggles Allworth faced over the years and how they changed their strategy.
It's interesting, like doing a radio show in Sacramento. If you've lived in Sacramento and you have a few dollars saved, odds are you know who Hanson McLean are, and you know who Allworth is today. So our brand's really strong there. So when we do some sort of marketing campaign, the results tend to be pretty good. And when somebody comes and talks with us, by the time they're talking with one of our advisors, they know who we are, they know our values, they know our value prop, and the conversions, it's fairly easy. Contrast that with we've got 30 some odd offices around the U.S. So if we do the same kind of marketing campaign in, let's say, Dallas, where nobody knows who Allworth is, it's a very different approach. I mean, our message is a little bit different. Even if they reach out, they're way out at the top end of that funnel. I mean, there's a lot of the whole kind of client conversion process is much different from someone who doesn't know us versus somebody that already knows us. So it's really fast. And you asked about challenging times. Like I remember there was a tax law change years ago, and I thought it'd be a great opportunity to have workshops. So we had 6 different workshops throughout Sacramento region, and we had 4 people show up. Not 4 at each, not 24 people, like 4 total. Like we had ads in the newspaper and stuff. We burned a lot of money on that one, but that's part of the learning and growing process. I mean, if you look to the lockdowns, which I prefer calling it lockdown versus pandemic because it was, I think, our response. But the lockdowns, the consumer behavior changed dramatically, right? So for a while, you couldn't meet anyone face to face, and then when things opened back up. Like we used to do a lot of live in-person events, and no one wanted to come to them. They were going to the theater and that sort of the show, but they weren't coming to live events. So like we really shifted our marketing approach. We're starting to see that kind of revert back to where it was. We're starting to see pretty big interest in having live events and client events, that sort of thing. So we're kind of leaning back into that. But it's just interesting watching how consumer behavior changes as the market evolves. Consumer behavior changes as well.
As we've heard, Allworth embraces a commitment to direct consumer marketing to drive growth and attract new clients. This marketing first mindset became quite attractive to private equity investors who were hungry to invest in RIAs. Private equity is something Scott and Pat were initially resistant to, but they learned that there was value in looking past initial assumptions and thinking in new ways about how investors might change the trajectory of growth for the better. Let's hear from private equity investor Andrew Dodson from Parthenon Capital on their investment into the business in 2017. Here he's going to talk about how he and his team helped unlock the next phase of growth at Allworth.
So we're, middle market private equity investors. All we invest in is growth companies. We as a firm are industry focused investors. So we focus on broadly financial services, healthcare services, and tech enabled business services. I help lead our financial services efforts. And within that, we tend to go very deep within specific subsectors. At the time, there were really only a couple private equity investments in RIAs. We set up a checklist of attributes that we wanted to find in our next investment in an RIA. And I think apropos of this conversation, number one was, a differentiated approach to organic growth. And, our at its core, our thesis has been since the beginning that you really have to have some sort of differentiated mousetrap in driving net flows to build a generational company, which is what we want to try to build, right? And in order to do that, driving growth is really paramount to what we're after. And so we literally came up with a list of 100 or 150 RIAs and began cold calling those groups back in 2015. And Scott and Pat were one of the first we called and reached out to based on some of our initial research. And literally for 18 months, they blew us off. They said they didn't have any interest in private equity. They were doing great, no interest at all in talking to investors. And I think we finally pestered them enough that they happened to be in San Francisco for a conference, and we convinced them to meet with us. And I think we sort of hit it off in that first date, if you will. And started digging in. And what impressed us about Scott, Pat, and Pete, and the team was, first of all, the culture that they built. This is an industry where assets go up and down the elevator every night, and so creating a culture that attracts and retains and motivates people is paramount to success as well. And they had created a fantastic culture. And behind that was a growth strategy that we found really, really compelling. And Scott and Pat had reached a point where, I think they had, all of their net worth in this business, as is typical for a lot of owners of RIAs. Their risk aversion, I think, was impacting their decision making. And they wanted to bring on a partner who could help them really take what they had built, expand upon it, and create a national RIA where, in Pat's words, his aunt could go into any one of their offices across their country and get the same level of service that he would hope for a member of his family. When we stepped in and started doing diligence on the company, we were super impressed by the level of data that they had, and how they approached getting clients in the door. They had expanded from radio into seminars and digital marketing and things like that. But they were able to track leads by source. So whether it came in from the radio, through a seminar, et cetera. And they actually controlled where that lead went within the organization. And so instead of an advisor being really solely responsible for going out and driving additional clients, they had a centralized home office driven approach to marketing. And so what I think really attracted Scott and Pat to us was we came in and said, look, our whole goal is to create that, take you from 2 billion to 10 billion, right, of AUM. And to get there, the way we want to do it is spend a lot more money. And they're like, what are you talking about? You guys are private equity guys. We thought you guys would just come in and cut costs and, just, focus on, driving the bottom line and not investing in the business. We're like, no, that's the exact opposite, right? We want you to triple the amount of marketing dollars that you're spending. We want to take you from, they were in Sacramento and they had a nascent business in Denver in the Bay Area. And we want to take you national. And we want to marry that with an M&A strategy that gets you into new markets where we can then apply this marketing savvy that you guys have and really grow the business. And it was that sort of shared vision that we developed with Scott and Pat and Pete, that one resulted in a great partnership, and two, I think drove with their leadership, obviously, a great success. So we have a team of folks employed by Parthenon who are functional experts who partner with our teams across everything from data and analytics to go to market to traditional sort of management consulting type projects. And so in the case of Allworth, we worked with them on identifying the right geographies to go after. And so we ran a big study where we looked at every MSA in the country and graded them on demographic profile, the number of high net worth individuals living there, the competitiveness of the radio markets in that case, right? And sort of stack ranked them from 1 to 100. And I think by the time we exited, we were in one market when we entered, and by the time we exited, we were in like 6 of the top 10 that we had identified. So we want to be, available on a functional project by project basis to help out where we can and deliver resources. We set out to build a $10 billion AUM business. That was sort of our goal when we first met Scott and Pat. We figured that'd take us 5 or 6 years. It took us, 3. I think the only disagreement that we really only had with Pat and Scott was we would have loved to have continued to be their partner for a longer period of time.
Here's Scott with more on how working with private equity helped change Allworth's growth trajectory and how the business had to quickly iterate and evolve their marketing and sales strategies as a result.
So one of the things that's interesting with Parthenon, when we sold the majority interest to them in 2017, middle of 17. And they came in, one of the first things they said is that you spend too little on marketing. You're too efficient in marketing. Like, what are you talking about? And so, we're very data focused. So we had all the stats, and they said, you should expect a lower return. Just invest more and have a lower return. It's still going to, maybe you're not getting those extremely ridiculous returns you're getting now, but you're still going to get a great return. And they're right. So we increased our marketing spend quite a bit, primarily in Northern California and in Denver, where we had some radio presence and that had great results there. But what we found is when we go into markets that we weren't known at all, because we didn't have any sort of brand presence, we were not having the same kind of results. So we really had to kind of tweak our marketing to a different playbook and really build out a robust website that has a lot of different trees that people go down or whatever that nurture marketing. So if someone goes on our website because they're interested in retirement income, we're going to lead them to something else that has to do with retirement income or taxes and retirement or something. And so we use a lot of the content on our website now to kind of build that relationship and move them down the funnel a bit. But we've learned we don't have the same kind of results. We've had to tweak our marketing and continue to learn. The nice thing about marketing, particularly in this day and age, when almost everything's digital, I mean, you know your results, right? It's not like the old days where you're wasting half your money. You know pretty soon what works and what doesn't work. What really is, I think, one of the bigger challenges for us, Meg, is that we've had to change our kind of sales approach. So historically, we haven't had to do a lot of selling. By the time someone's talking to one of our advisors, they know us a bit. They've listened to us maybe for months or years on our show. Like they're ready to go. I mean, a dog with a pin in its mouth could close half the business that came through the front door. But when you go into a market where we're not known, so like a new market where a firm joins us, the advisor, maybe he or she's a great advisor and they built up a great book, but it's also been through people that have all been referred. So by the time someone's there, they're already kind of predisposed to become a client. To now, maybe someone's interviewing 2 or 3 people, particularly on Zoom, like a lot of first appointments. If I was a consumer, I'd want a Zoom appointment to begin with. Like, why would I want to drive across town and meet somebody? So a lot of times people are shopping, and our advisors, or now we use some business development people, because there's a sales process that needs to occur to get the client from, I barely know you, I've got a problem, but I don't barely know you, to, oh, you have a solution for me and I trust you and let me sign the paperwork. So that's where we've had to tweak quite a bit. Like we can generate great leads. It's the conversion has been much more challenging in markets where we don't have that brand. And we were slow, frankly, we were slow to catch that. We would see it in the numbers, but it had to take a bit of tweaking in our business model. It's funny, sales is a dirty word to some people, right? Particularly in our industry, fee-based advisor and all that. But it's really a communication strategy and a process. It's a process you bring somebody through. They've got a problem. And no one goes shopping for an advisor because they have nothing else to do in their life, right? I mean, think how horrible that would be. The first time you meet with an advisor, here's all my financial mistakes. Yeah, I don't have enough money saved. I'm stupid here, stupid there, right? I mean, it's just I can only imagine how painful it is for a consumer. So when a consumer's talking to an advisor, I mean, if you should be skilled enough to convince that person to make that decision today to hire you, put them out of their misery.
So how did the evolution of their marketing, the rebrand from Hanson McLean to Allworth, the shift in sales processes, and the increased investments in marketing work out for the business?
When we brought in private equity and sold the majority stake, a couple things happened. One is we really shifted our approach. Instead of focusing on cash flow, it's really focusing on enterprise value. How do we create the most valuable company across the board for Allworth? And then secondly, from a personal standpoint, I had sold a business before to a Fortune 500 company, that a side business that Pat and I started in the 2000s. So I'd had a liquidity event before, but I think this one was a little different because, well, one, it was just, the size was good. It was just kind of the point, like I have enough cash that if the company blows up, like my family's still fine. My lifestyle is not going to change at all. But if we can hit a home run, it's going to be pretty exciting for everybody. So my risk tolerance completely changed. And it's kind of like, I shouldn't really say this, but I feel like you're kind of like on house's money now. You know what I mean? You get your chips off the table. This is off. And so it says, look, I told the team, let's just run as fast as we can and as hard as we can. There's some small probability that this won't work out. And if that's the case, then that would be a bummer, but none of it's going to be destitute. But there's a high probability that we'll be successful. And so, we've had a great run since we brought in private equity. We were Parthenon with them for about 3.5 years, and they had a great return. We had a 10x return over that period of time, which was, and in fairness, some of it was just kind of luck of timing. A lot of good things happened. We clearly grew our EBITDA 5x during that time. The reason it was a 10x return is because the market, the larger you get, the higher the multiple you get, and multiples had increased over that period of time. So I can't really get credit for those things, but it still panned out in the end. So.
From Parthenon to Allworth's current investors, private equity firm Lightyear and the Ontario Teachers Pension Plan Board, the business significantly leveled up their M&A capabilities and continued to innovate their marketing strategies. The business grew significantly in size and scale from 2017 to 2023, and after 3 decades of growing a thriving business, Scott and Pat decided it was time to step down from being co-CEOs and look to the next stage of their careers. It's not easy to choose to move forward from something you built from the ground up. In our conversation, Scott openly shared some of his reasons for stepping down as CEO and offered his perspective on the future of the industry and his own career. Here's Scott.
Yeah, so it's been 6 months now, at the time of this recording, to the day that stepped aside as CEO. Over the years, though, Meg, I've we brought in someone to run what was then Hanson McLean, be the president. He was Steve Burnett, strong leader for us. And so he kind of took care of the daily operations for many years. And then Pete Ingleton joined us as our chief operating officer, I think about a dozen or so years ago. Very much a detail guy. Frankly, he was doing a lot of the CEO roles anyway. But when you bring on private equity, the game changes a bit, right? the kind of governance and expectations it takes it to a new level. And then we got to the point we had 400 employees. I just found myself parts of the job I really loved. I mean, I felt very fortunate to work with so many bright people, and it was really interesting. I learned a lot. But it got to the point where a couple of things. One is I started to question if I was really the right person to take the company from 400 employees to 4,000 employees. It's funny. I was having a conversation with my wife, and I said I didn't have the skill set. She says, well, you could have if you really wanted to. And I thought, maybe she's true. Maybe that's fair. Maybe not. I don't know. But I didn't really have that burning desire to invest. I was working more hours than I was, in years. I mean, my first decade or so, I worked my tail off, and then I had a lot of years I wasn't really working that hard. Not a lot of vacation stuff. Now I found myself in the family vacation in Croatia and sitting there on Zoom calls with the board. So. It's a combination of what I thought was best for the organization and what did I really want personally. And so it's been an interesting transition. One of the things that's been helpful for us is we get some new, our leadership team. A lot of people came up through the organization or through our partners, but there's a couple of outsiders as well. And sometimes when an outsider comes, they just have a different view, at least for the first year. One of the advantages we have right now is John Bunch. He's new to Allworth. He'd spent the last 5 years in the United Kingdom, and now he's back stateside and running Allworth, and so he's got a little different perspective, and maybe he has spotted a couple of things that we either didn't see or had ignored perhaps in the past. Usually, the thing I love about the marketplace business in general is, the numbers don't lie, right? So every quarter, every year, you know exactly if you're providing, if your customers like you or if they don't like you, right? It's just and you can drill down in every little area of your business and see where you're having success and where you're not, and focus on those areas that you need some refinement.
I've had the privilege of knowing Scott and Pat for many years, and I celebrate their decision mid-2023 to bring in a new CEO to lead the business forward while continuing to be involved in different ways. As Scott said in one interview last year, I'm not retiring, nor am I leaving. I'm moving into a position that more closely aligns with my skill sets and passions. This is an important lesson for founders. Whether you choose to be like Brent Brodesky from Savant and constantly reinvent yourself to be the best leader for the business, as we heard in episode 6 of Growth Leaders, or you choose to be like Scott and Pat and transition from the CEO role, we all need to be asking ourselves, what is the best for the business? For Allworth, it was bringing in new CEO John Bunch. So how has the new leadership team at Allworth tackled the transition from founder-led to professionally managed? And where are they leaning into for future growth opportunities? That is coming up right after this quick break. Podpony is the all-in-one podcast partner for thought leaders and business owners. They provide everything you need for your podcast, including audio and video engineering, graphic design, podcast social media support, on-site filming, and more. From initial concepts and strategies to production and distribution, the experts at Podpony are with you every step of the way. Learn more about Podpony by visiting podpony.com and start your podcast journey today. Now let's get back to the show. Now it is time to hear about Allworth's business today and into the future. John Bunch came on to become CEO of Allworth in 2023 after Scott and Pat transitioned from their co-CEO roles. Navigating leadership change can be difficult for any company, but it can also lead to exciting new opportunities for growth. Let's hear from John Bunch on his approach.
There's an old adage that don't be the first CEO after a founder because it usually doesn't end well. So I'm actually 3-0 so far, so I'm pretty excited about it. And that's really why I joined. I have known Pat and Scott for almost 14 years. It was the perfect size, and the business was really in the best strategic place I thought it could be for growth. And so when Scott called me, I said, I would love to do it. There's a certain size of company that's easier to grow and to build the infrastructure and really kind of put an accelerator on it. And as you get bigger, it's really the law of large numbers. If you have, $100 billion in order to grow 5%, you need to bring in a lot of money just to break even. And so at 23 billion, it is big enough that you can get scale. You have the marketing dollars to actually spend for growth, but yet you're not stuck in the situation where it's just too hard to move the organization. I have a kind of process I follow whenever I take over a company, and it's first listen to the employees. So my commitment to the employees was the first 90 days I would talk to every single employee in the company. And I think when you do that, you have to realize you're going to get the good, the bad, and the ugly. And so you have to, I think, be organization mature enough to kind of weed through that and make sure that the right levers you're going to pull actually make the biggest impact. But really, there wasn't anything that I was like, oh my gosh, how am I going to fix this? Or wow, this is amazing. It's pretty much where I thought it would be.
So you spoke with all of the employees and all of the advisors in the first 90 days?
421 people.
I just want to pause for a moment and emphasize what John did. He met with all 421 of his employees in one-on-ones and small group meetings. He farmed for feedback, and he took all of that feedback into his decision-making. If you're a CEO, you can appreciate how rare it is that our schedules allow for us to have as many conversations with our teams as we'd like. It's even harder when you do get that feedback to adapt quickly. With John's intentional approach, he was able to identify the next steps to grow Allworth and drive a stronger company culture.
I think when you do 31 acquisitions over a 5-year period, you adopt policies, procedures, ways of doing business that if you take a step back, you didn't realize it was as complicated as it really is. And so after listening to the advisors and the client service professionals, it was clear that we needed to kind of take a step back and move more towards a boutique feel I think that we were being a little bit too clever and trying to be a bit too big box and institutional. We had lost that connection between the advisor, our service professionals, and the client. And so that was the first thing we did, which was really kind of move the power back into the advisor ranks in order for us to kind of, really deliver a great client experience. We've always been a planning firm and led with financial planning, but I think that we were probably a bit behind on adopting some of the new technology that uses AI in the marketplace. And so we went out immediately. We found two great partners to help us on the tax planning side of the business and on the estate planning side of the business, and a very AI-driven kind of a value proposition so that you're not spending the 3, 4, 5 hours that you would traditionally have to do to think about tax planning for a client. You're actually able to scan a tax return, and the machine learning actually kind of pulls up what is most important. And so those were two things that we did right out of the gate to strengthen our value proposition.
Having improved their systems and grown so much inorganically, how does a company that always had such a strong core marketing ethos continue to drive growth in new markets?
So I'm a bit lucky on this front. I have worked for the three founders that were the best marketers in this space. So Rick Edelman, Adam Bold, and Scott and Pat. So if you kind of think of the iconic individuals that built the RIA industry, those are four of the probably top 5 or 6 folks. So you hit the nail on the head, which is this is all about geography, right? And so, if you think about the origin of Pat and Scott's radio show, most clients were walking in almost pre-closed. That doesn't mean the advisors didn't have to work hard, but they knew, they probably listened to the radio show for a year and they were ready to make that decision. They walked into an Allworth office. I think with the new age media, which is a combination of search, paid leads, the custodial referral programs, what you're having to do is not only market to acquire those leads, but the real secret sauce is you have to be able to convert those leads. And if you think about, old marketing, which was radio show walk in, it was pre-closed. In today's world, you're competing against sometimes 3 or 4 individual firms on these paid leads. And you really have to hone your value proposition, how you position yourself in the marketplace, and frankly, how you close that business. And so we're in the middle of this, working across geographies, working across kind of ways that we can train and help our advisors. I think that it, sounds simple. It's actually just not that easy. I'm confident we'll get there. I think the entire industry is struggling with organic growth. And I think that, if you kind of go back 10 years, being a fiduciary, being in this marketplace was rather unique. And now almost everyone says that they're a fiduciary, right? That's no longer a strategic position for us. And so for me, this is more about kind of execution quality, because, you're going to buy the leads, you're going to have leads come into the system. It's really about how you refine the processes in order to make that happen. Today, we've got 25 people going through a training just on this topic to help people understand how do you talk to clients, both over Zoom or Teams, whatever vehicle you're using, or face-to-face, because those are two totally different sales processes. If you would have told me 10 years ago, my mother would be on a computer having a financial services conversation, I would have laughed. I'd been like, good luck. But in today's world, right, I have my daughter when we were in London, we were on, Zoom all the time talking to her grandmother. And so it's just a different world. I think, the consumer actually is smarter today as well. So, 12, 13 years ago, the notion of ETFs, lower cost investing, cost of portfolio, that just wasn't there. Today, that's kind of at the forefront of almost every conversation.
As you've heard John mention, Allworth is serious about client experience. They were so serious, in fact, that after they acquired RIA firm Affinity Financial Advisors, they brought on the CEO of that firm, Victoria Bogner, to become the Director of Client Experience for Allworth. I asked Victoria about this career evolution and what she took from her time as a CEO and advisor into this new role.
It was really an interesting shift because I had been doing my old role for 20 years, and I had gotten to the point where I really wanted something fresh and new. And Allworth certainly delivered when they offered me the Director of Client Experience role. It's not something that I had ever done before, so it was definitely outside of my comfort zone, But also what's so great about Allworth is that they said, you know what? We trust you to grow this into something that's going to elevate the company and just take your experience and run with it, which is what I've done so far. So being able to take my experience as a financial advisor, as a money manager, as running a company and growing it over the past several years as I was CEO really helped feed into, okay, well, if I'm a client or if I'm an advisor, what are the kind of things that I want to experience and see? What are the kind of things that would really frustrate me that I want to make sure we can overcome? What is that white glove experience, and how do we segment that out for different clients so that everyone is treated very fairly, but those high net worth clients are especially treated with that concierge level of service? It has evolved into really touching every part of the company. So it's not just the client experience. It's also the Allworth experience. It's the advisor experience, the service team experience, because that feeds into the client experience. When I was brought on, it was made really clear that there was no client journey map. So I asked for, okay, what is the client journey map? Well, there isn't one. Okay, great. Well, step one is to build the client journey map. What exactly is the client even experiencing from their first contact with Allworth all the way through to the first 2 years of their client experience? So we actually hired a consultant to come in and help us determine what that journey was. And that was really critical because I was able to get into a room with the heads of multiple departments of Allworth. So I immediately got to know them well. We locked ourselves in a room for 2 days and we mapped out the client journey. That also ended up mapping out the advisor journey and the service team journey, because that all feeds into the client journey. Then when we looked at each tranche of what that client journey was, we identified what is the tranche that is especially in need of extra love and care. And when we looked, it was the onboarding experience. The onboarding experience really needed to be dived into, have some gears changed and rearranged to make sure that that flow from the first moment we contact a prospect all the way through to them officially becoming a client in their first 90 days, we wanted that to be exceptional. So that was our focus in the very beginning. And that then is what fed into enhancing things that were natural offshoots of that onboarding experience for the client. When I joined Allworth, operations and client service was centralized. So we had the advisors in their local office, but their client service specialist, their operations person might not have actually been in their local office. They might have been in a completely different time zone. And what we discovered as a whole, as Allworth in general, that was not the best strategy. Well, in theory, it seems like it would be more efficient. In practice, it just took away from that local feel of each of those offices. That when a client calls in, they want to talk to somebody in that office. They don't want to talk to somebody in a different time zone. They don't want to talk to a different service team member every time they call in and they're not sure who they're going to get. So a big part of the effort was bringing back those people into their local areas, having definite assignments of these service people service these particular advisors. So if that client calls in, they're getting Heather or Kara every single time. And that service person knows that client and their situation and can follow that all the way through to the end of a service request. So it's been very important for us to build that local feel back into those offices. And that has been extremely positive, not only for the service teams because they know their expectations and roles, but for the advisors and the clients as well. It's been huge.
When you've been in business as long and in as many regions as Allworth has been, changing your approach can be difficult. This is especially true when a company has grown significantly from inorganic growth and they are trying to marry different company cultures together. I asked Victoria how she navigated getting buy-in.
It's got to be easy. And that's how we're going to get that buy-in and that implementation. But also, I wanted to make sure that we allowed room for the advisor to be themselves, to still interact with clients in the way that those clients have grown used to and come to appreciate. I like to say that we try to be unified, but not uniform. So as long as we have those building blocks in place, then the advisor is free to input their own personality, their own style, but we have that process as the backbone for making sure that the client has consistency, structure, that expectations are set, that we're treating the client as a part of the Allworth family, and they know that they're at the center of everything we do, that the advisor is just one component of the value that they get from Allworth. They also have the investment management, our integrated services with estate planning and insurance and tax. So when they join Allworth, they're not just getting this amazing advisor, they're getting an entire team that surrounds them. Client experience has really become cross-functional. So I work with nearly every department in the firm, even all the way down to billing, to make sure that that client experience is connected throughout those touch points, throughout all of those departments.
So Allworth has created a new plan, gotten buy-in from the advisors, and created a beautiful new system. But how do you know if all this work is really paying off? Of course, the answer is data, data, data.
Something that we send out are client surveys. So we send out surveys of clients that have experienced their first 90 days. So we want to make sure that that first 90 days has been exceptional. And then we send a survey to clients who have been with us for 1 year. So we want to see that those satisfaction scores are very high. And if we're getting feedback, we want to know what's broken. Also, we have the service team led by Pat Green, who has been really intentional in bringing the service teams back to the local level so that they're more in touch with advisors and clients to know and respond to what those client needs are. And we measure that as well in surveys, and that has shown significant improvement, not only with clients, but also with advisors. So we send a survey out to advisors as well, as far as their satisfaction with the level of service that they are receiving and their clients are receiving. So we can keep track of how people are feeling about how things are going at Allworth, which is important. But then to get to your point, the hard metrics, are we getting more referrals from clients? Are our retention ratings higher? So all of those kind of tangible metrics we want to keep track of and make sure that we're trending in the right direction, as well as new money, new AUM coming in the door from existing clients and new clients.
And so is it safe to assume you're seeing a positive trajectory there?
Yes, we are starting to see some really statistically significant change in the right direction with some of the things that we've implemented, and that's really exciting.
What does Allworth see on the horizon for advancing growth in the industry and improving the client experience? Here's Victoria on some of the technological advancements they've been making.
Our next big challenge is that we are integrating new partners all the time. And we want to make sure that as we're growing, we're not losing that personalization that we're experiencing with the client. So something that we're always looking to iterate and improve is how can we automate what can be automated, and how do we continue to be personal in areas that really need to be personal, really need to be relational. And as we get bigger and bigger, that becomes more and more challenging. So there are tools that are being developed that allow us to have what I like to call personalized automation, so that in the background it's being automated, but the client does feel like it's a personal touch. And the advisor is still kept in the loop, so that that relationship is intact and growing, but it frees up the advisor's time immensely. So there are tricks and tools that we're implementing to be able to keep that personal feel, but that is going to be a challenge as we go forward and as we grow.
And are these tools that you're building and that are proprietary tools, or there's off-the-shelf tools, combination of all of the above?
It's a combination of all the above. So a lot of those things we have built ourselves with our amazing IT team who is brilliant. So building in processes and workflows in our CRM and our database in order to be able to automate tasks, emails, flows, and then also working with outside vendors who have a process that we can implement and integrate into what we're doing that also requires us to build some customization in order to get our services to talk to each other. But also really exciting. I feel like we are constantly on the cutting edge of what is possible to be able to deliver the absolute best service and experience to the client. And that's really fulfilling.
While Victoria has been looking at the day-to-day advancements that can be made for the client experience, CEO John Bunch has an eye even further in the future. Here's John on what he hopes for Allworth in the next 5 years and beyond.
I think that when you make a transition from founders, when you do 31 acquisitions, building a culture where people want to come to work and are thrilled and inspired about the work we do is first and foremost. And second, I think that the consumer is going to demand more from an advisor in the future than they do today. Investments is truly a commodity. I think most parts of financial planning will become a commodity. So I think you're going to have to think about how to engage a client about their overall life, whether it's, what do I do after I retire? If I retire at 55, I'm probably going to live 40 more years. What does that life look like? Or the health and wealth side of that equation. I think the days of I'm either an investment manager or I do a simple financial plan 5 years from now, I think those will be commodities. And I think AI is a bit like Y2K. I think everyone thinks, well, really, how important is AI going to be? I just came from a conference, and what they're doing today with AI, and it's in the early stages from a financial planning perspective, can take like a normal financial planning meeting prep time is like 45 minutes to, let's say, 90 minutes. Using AI technology, I watched them put together a presentation in 6 minutes. 6 minutes. Yeah.
Wow.
It was wow. And so, I think that it hasn't hit this industry yet, but I think that it's going to be the biggest transformational change that we've seen in the last 30 years.
That will enable your advisors to be able to deliver that level of service.
Exactly, right? Because if you think about, the ability to kind of scan the universe, to come up with a plan, to get the best proposals, to look at healthcare, to look at longevity, not having to do that level of research and actually focusing on the relationship, I think is going to be the big turning point.
And you've mentioned a few times, 31 acquisitions in 5 years. What pace are you targeting? Is a similar pace for Allworth's acquisitions year over year, or does it depend?
Yeah, you sound like my private equity owners right now, Meg. So it's quite simple, right? The market dictates everything here, which is, we want to buy firms and integrate them to be part of our culture. And it really the biggest dictate of that is they need to have firms that are for sale. And so, this is an aging generation of financial advisors. I would like to see us probably do bigger deals versus the ones we've done in the past that are, a bit more EBITDA driven versus kind of smaller deals. And, I think this year is probably going to be our best year ever on acquisitions. And so, I think the next 3 to 5 years are still going to be very robust on that front. What I care about is, the advisors and the employees inside of Allworth are inspired to come to work every day. If that happens, they're going to do the best job possible for clients. And I think one thing that makes Allworth different, if you kind of look at the landscape in the RIA community, is most people are going up market, right? Ultra high net worth. We're really a firm that's there for the millionaire next door. And, I think, to me, that's very inspiring because those are the folks that usually are taken advantage of, that have worked their entire life to save up, $500,000, $1 million. And one financial mistake can ruin their retirement. And for me, that's why I come to work every day, which is making sure those individuals get the best quality advice and that we help them achieve their financial dreams.
Allworth is a company with a marketing-first mindset that has strived to have a strong connection to their clients and keep an eye to the future when it comes to driving growth. They've shown that building a company culture that is always looking for opportunities to improve internally leads to better business outcomes. It is what has set them apart to become one of CityWire's 50 growers across America. After my time speaking with the team at Allworth, here are my key takeaways. 1. Don't be afraid to have a marketing-first mindset. Often in the RIA space, marketing is treated as an afterthought. Allworth has demonstrated how a consistent marketing drive has not only grown their company organically, but also driven a positive industry reputation. In building their radio show, which is now also a popular podcast, over the course of 30 years and becoming a household name, brought clients in the door already sold and created a launch pad to growth. 2. Being a part of a community builds trust with your clients who want to know that you understand their unique needs. Allworth realized that their winning strategy from the beginning was a strong connection to community. As they've expanded nationwide, returning to that approach has stretched their growth even further. 3. Keep an eye on customer experience, whether it's their first phone call or their third decade as a client. Allworth is leaning into new practices, including advancements in technology, enabling advisors to streamline the busy work and focus on building relationships. 4. As a CEO, prioritizing feedback is crucial. As I learned from John, having a successful business starts from the inside out, and building a strong company culture with an intentional approach to communication is vital to growth over time. 5. If an old strategy isn't working anymore, pivot. It can be hard as an institution to recognize that an approach that worked in the past is no longer serving the business as well as it could. Boldly shifting your tactics mean you lose less time driving growth. I'd love to hear your key takeaways from this episode. I hope that you'll find me on LinkedIn and send me a note. You can find my LinkedIn profile in the show notes. For more valuable growth resources like this, please visit ficompartners.com/insights. Join us for the next episode when we'll be speaking with Advisors Excel Wealth Management.